Cô tên là Đinh Thị Thanh Vân và cô là giáo viên của khoa Tài chính Ngân hàng. Thì kỳ này cô có đảm nhiệm dạy 2 buổi học, buổi ngày hôm nay và buổi tuần sau. Tức là cô sẽ dạy các em 2 buổi online. Thế còn buổi trước thì chắc là cô thấy cô Hương có dặn cô là trong cái buổi học ngày hôm nay thì chúng ta sẽ có 2 nhóm sẽ thuyết trình và cô sẽ dạy cho các em trong hai cái tuần này thì cô sẽ dạy cho các em chương 15. Tức là chương 15 là cái chương liên quan đến ngân hàng trung ương và cung tiền. Thế thì cô confirm như vậy có chính xác không hả các em? Đúng rồi đúng không? Thế thì ok, thế thì cái buổi hôm nay đầu tiên thì chắc là cô sẽ lắng nghe 2 nhóm trình bày trước. Thế thì sau đó thì cô sẽ giới thiệu với các em về cái phần 1, tức là phần liên quan đến ngân hàng trung ương và giới thiệu qua một chút về về cung tiền trong buổi ngày hôm nay. Thế sau đó thì buổi sau thì chúng ta sẽ học nốt và chúng ta có thể nếu mà chúng ta có nhiều thời gian thì chúng ta sẽ chữa thêm một số bài tập nhé. Ok, thế thì hôm nay là 2 nhóm nào sẽ trình bày nhỉ? Các em sẽ trình bày trước nhé. Thì cô sẽ để cái thời gian để cho các em trình bày xong rồi khi mà chúng ta trình bày xong nhóm trình bày trước thì cô sẽ chờ để nhóm thứ hai cũng chuẩn bị. Thì các em hãy chuẩn bị sẵn sàng slide của mình để cho các bạn cùng nghe cái buổi thuyết trình của mình ngày hôm nay nhé. Hôm nay là nhóm nào và nhóm nào phải thuyết trình nha các em nhỉ? Ok. Theo cô biết là cái buổi học này của chúng ta sẽ bằng ngôn ngữ bằng tiếng Anh. Thế cho nên là các em thuyết trình bằng tiếng Anh nhé. Thế sau đó thì cô cũng sẽ chút nữa thì cô cũng sẽ dạy bằng tiếng Anh. Nhưng mà trước khi chúng ta vào thì thống nhất để cho các em có thể biết cái quy trình học của chúng ta. Nhóm nào trình bày trước các em có thể kiểm tra xem mình đã share được slide chưa? Ờ, 2 bài tuần trước. Em lưu ý nhé là thuyết trình thì chỉ 25 phút bao gồm cả thời gian mình thuyết trình lẫn thời gian mình để các bạn đặt câu hỏi cũng như là để cô có thể có câu hỏi cho cái bài thuyết trình của mình. Nhóm 3 à em? Lớp mình bạn nào là lớp trưởng nhỉ? Có lớp trưởng không? Alo? Em thử share slide xem có được chưa? Thế nhóm 3 thuyết trình trước đúng không? Các em share slide cô thử xem cô chưa nhìn thấy gì cả. Nhóm 3 là có những bạn nào nhỉ? Các em có nghe cô rõ không? Là cô nghe tiếng nó cứ bị ngắt quãng.
Bọn em có nghe cô rất rõ.
Ok, vậy thì share slide trước nhé em nhé.
Cô ơi, cô đợi bọn em một chút với ạ, tại vì là cái bạn lập slide của bạn ấy đang bị lỗi mạng một chút nên là bọn em đang chưa share được ạ.
Thế à? Thế liệu nhóm 3 chưa share được thì nhóm nào trình bày ngày hôm nay nữa có thể trình bày trước cho nhóm 3 không? Trong lúc các bạn đang bị sự cố kỹ thuật. Nhóm 3 với nhóm nào trình bày hôm nay hả các em?
Nhóm 7 cô ạ.
Nhóm 7 có trình bày được không em?
Được,
Ok.
được ạ.
Ok. Thế nhóm của Quân đúng không? Nhóm Quân sẽ trình bày trước nhé.
Vâng.
Ok. Rồi, tất cả mọi người đều đang sẵn sàng nghe nhóm các em trình bày rồi. Bảy. Cô đã nhìn thấy slide rồi, các em có thể trình bày đi. Alo?
Đây em vừa bị lag mạng một tí ạ.
Ok.
Okay, so today our group 7 will talk about the central bank. Chuyển slide giúp. This is here are our member. And our instructor. Mình có thể chuyển luôn vào mục chính nhé, vì thời gian có hạn ấy. Okay, so first I will talk about the central bank. So the first is I will talk about the definition of the central bank. Chuyển tiếp. So the central bank is a financial institution given privilege control over production and distribution of money and credit for a nation or a group of nations in modern economies. The central bank is usually responsible for the formulation of monetary policy and the regulation of member banks. So next we will move to the role of central bank. So the first one is okay. Before we go into each role of it, I have to say that central bank in the world have many big responsibility. So now we will move. So it have many role, and the first one is central bank print money, so which goes to circulation in the economy and is used by people, household, business, firm to create transaction, and essentially it check where the spending is going. The next one is that central bank have to ensure stability of the financial system in the economy. This means monitoring lending started across the economy very closely, as well as making sure that there is easy access, easy way to access to credit when required. In this case, they are also lender of last resort to commercial bank and the government, which means when the government or the commercial bank require money and they no other way to access through the necessary funds, the central bank can be the last lender of that. And the next role of central bank is monitor and track economic data, which is one of the key functions of the central banks. And this role and as it grow and usually is a way to see the economic data. For example, the Bank of England produced mọi người em bị đau họng. For example, the Bank of England produced its quarterly inflation report, which come out with various detail on GDP, growth forecast, inflation forecast, as well as commentary on specific macroeconomic themes at that time. And the next role of the central bank is that the central bank set monetary policy. Monetary policy had a wide array of individual tools, and the key is setting its interest rate. And the last role of central bank is the main it have the main mission in the economy is that it have to guarantee the price stability by minimizing the inflation and deflation about 2 to 3%. Yeah, with some central bank policy. Yeah. So next we will move on to the next part is the function of central bank. So the first function, and this is one of the key functions, is the monetary policy. So the central bank will issue the money and the ability to strong influence the operation of the bank system, which is considered to have a great ability and in controlling and regulating the volume of money supply in circulation. So it has been assigned responsible for formulating and implement the country monetary policy, and the central bank perform the state management of money and bank activity in order to ensure the safety and the efficiency of the bank system. Next is the banking. The next question is banking and foreign exchange operation. The banking activity are monetary business activities and banking service with usual content of receiving deposits and using money to provide signal and provide payment service. The foreign exchange activity activity of investing, borrowing, lending, guaranteeing, buying, selling, and other transactions in foreign exchange. The next function is perform the function of a central bank in issuing money. The central bank is the only authority to issue cash, including banknotes and coins. Through this function, central bank can influence the national monetary situation, thereby affecting the macro factors of the economy. And the central bank provides money into the circulation through some channel like government credit channel for the intermediary banking system, open market channel, and foreign exchange market channel. And the last function is this is the bank of the government, acting as a treasurer for the state treasury by performing the management of account and other financial instrument of the state treasury. So we will move to the last part of the central bank. That is the characteristic of the central bank. So it have three main characteristics. So the first one is that central bank control and manipulate the national money supply. Central bank issue currency and fixing interest rate on loans and bonds. So the central bank will raise the interest rate in order to avoid the inflation and lower the spur growth. Next is the central bank regulate. The central bank regulate member banks through capital requirement, which dedicate how much bank can lend to the customer and how much cash they must hold and money guarantees. So for example, you okay. For example, when you give money to the bank, so they will use some of it to invest or do something, and the central bank will put the amount they have to hold and the amount that they can use of that money. So, and now we will move to the last part. The central bank could be counted as an emergency lender to struggling commercial bank and other institutions, and sometimes is the government. So by purchasing government debt obligation, the central bank provides a policy attractive alternative to tax when the government need to increase revenue. So that is all the information we want to give you about the central bank.
Now we will move to the European Central Banks, mean ECBs. Firstly is the definitions. The European Central Banks, as known as ECBs, is a central bank responsible for the monetary policies of the European Union's member countries that have adopted the euro currencies. And the European Central Bank is headquartered in Frankfurt am Main, Germany, and it has been responsible for monetary policies in the Europe area since 1999, when the euro currency was first adopted by EU members. Secondly is the structures of the European Central Banks. The ECB is made of 4 decision-making bodies. First is the General Councils, operates as an advisory bodies of ECBs, includes all of the EU member, EU's national central bank governors, as well as the presidents and vice presidents of ECBs. In other words, the General Council includes the presidents and vice presidents of ECB and all of the governors of the central banks of the European Union. Secondly is the executive board, where day-to-day decisions are made. This consists of the presidents of the ECBs, the vice presidents, and 4 other members, chosen every 8 years by European councils by qualified majority of persons with recognized authorities and experience in monetary or banking matters. Thirdly is the governing councils, comprise executive board and all of the Eurozone national central bank governors. It set monetary policies for euro areas. The governing council, which chaired by the president of ECBs, it has main decision-making bodies of European central banks. It consists of 6 members of executive board and the governors of the 20 central banks of the Eurosystem countries. Last but not least is a supervisory board. Since 2014, single supervisory mechanisms means that SSM has existed in Europe and comprising the ECB and national banking supervisory authorities. This includes the Supervisory Council, the 4 decision-making bodies of the ECBs, which consist of president, a vice president, member of executive board of the ECBs, and 4 representatives of the ECBs and representatives of national supervisory authorities. Thirdly is the role of the European central banks. First is maintain price stability and safeguard the value of the euro. Firstly, the setting key interest rate. The ECB's key interest rates are interest rate at which lends money bank and banks lend money to each others. By raising or lowering key interest rates, the ECB can influence the cost of the borrowings and lending the Eurozone economies. Secondly, they can controlling the money supplies. The money supply is the amount of monies correlations in an economy, and the ECB can control the money supply by buying or selling government bonds or other assets. Last but not least is conducting foreign exchange operations. The ECB can intervene in the foreign exchange market or to buy or sell euros in order to influence the value of the euro against other currencies. The second role of the ECB is to promote the smooth operations of payment system. The ECB is responsible for banking supervisory in all EU member states. The European central banks carry out this function through the single supervisory mechanisms that comprise the ECB and competent national authorities in the member countries. Moreover, they can conduct foreign exchange market operations. The ECB foreign exchange operations can broadly be divided into 2 categories: defensive and offensive operations. Firstly, the defensive operations are conducted to prevent excessive volatilities in the euro exchange rate. This can be done by buying or selling euros in foreign exchange market to smooth out inflations in the euro values. And offensive operations are conducted to influence the euro exchange rates in particular directions. And the ECBs conduct foreign exchange market operations in many ways, such as spot transactions, forward transactions. This involves buying or selling foreign currencies for deliveries at the future rate, swap, and options. And the last role of the ECB is the ECB has a monopoly and issuance of banknotes in the euro areas. The ECB makes weekly announcements on the amount of money it wishes to supply and the minimum acceptable interest rates. And moreover, these reserves are used to support euro and to intervene in the foreign exchange market if necessary. The last role is to support general economic policies of the European Union. This includes taking into account the needs of the wider economy when setting monetary policies. Next is the functions of the European central banks. The first function is the currencies authorities. The ECB has the sole authority to issue the banknotes used all over the Eurozone, and the ECB issue all of the notes but not produce euro coins as the national central banks produce them on their own. The limit in the issuance of the coin established by people's hands. Next is the banker to the national central banks. ECB as a banker, general, and financial advisors to the NCB. is make investment in economies and keep account for all of the member nations. It formulates an interest rate policy that have to comply with the NCB to maintain the money supply in their respective economies. The third function is the authorities to the national central banks, ECB, as and supervisors and regulators of the functioning of the NCBs to ensure the public confidence. Moreover, it acts as a custodian of the cash reserve of the NCBs, and the NCB are required to keep some cash reserve with the ECBs. In this way, it acts as a custodian. And the last is the maker of the monetary policies. These are the only institutions that formulates the monetary policies, which has to follow all of the ecosystem. A change in the interest rate by central banks makes the commercial bank change borrowing rate to the public corresponding to the central banks. The monetary policies attempt to keep inflation under 2% in the medium long term. The last part is the characteristic of the European central banks. Firstly, they can independence. The ECB independence enrichment to treaty on European unions. This means that ECB cannot instructions by governments or other political bodies when setting monetary policies, and the ECB independence is essential for its ability to make decisions that are the best interest rate of the Eurozone economy as a whole, with being influenced by political considerations. Secondly is the accountability. The ECB accountable to the European Parliament and the European Council. This is ensured through regular reporting and oversight these institutions. The ECB also publishes its monetary policies decision and publishes regular forecasts to the Eurozone economy. Thirdly is supranationalities. The ECB's, which means that it's above national central banks of the Eurozone countries. This is essential for the ECB ability to set monetary policies for the Eurozone as a whole. If the ECB were subjected to influence of the national governance, it would be difficult to set monetary policy that is the best interest rate in the Eurozone economy as a whole. Last but not least is pluralisms. The ECB governance compose the ECB president, a vice president, and a governor of the national central bank of the 19 Eurozone countries. These have to ensure that the Eurozone countries have a voice in the setting of the monetary policies. This is important because it has to ensure the ECB monetary policy decisions are made in a way that take into account the needs of the Eurozone countries.
Okay, I think your group have to be quicker because you have only 10 minutes left.
Okay, let me talk. Let me present faster. Let's move to the overview of federal reserve system. The first is definition. The federal reserve system is the central bank of the United States, often called the Fed. It's globally the most influential financial institution in the world. It was found to provide the country with a safe, flexible, and stable monetary and financial system. Okay, let's move. Next slide, please. And the Fed had a board of 7 members and 12 Federal Reserve banks, each operating as a separate district with their own president. Here is the Federal Region Bank. Okay. And this is the Federal Reserve System consists of a Federal Open Market Committee, Board of Governors, and Federal Reserve Bank. And the Federal Reserve System is independent because the Fed is also considered independent because its decision do not have to be ratified by the president or any other government official. However, it is still subject to congressional oversight and must work within the framework of the government's monetary and fiscal policy objectives. Let's move to the function of the Federal Reserve System. The first is conducting the national monetary policies by influencing monetary and credit conditions in the US economy to ensure maximum employment, stable price, and moderate long-term interest rate. The secondly is helping maintain the stability of the financial institution and seek to minimize and contain system risk through active monitoring and engagement in US and abroad. The third is supervising and regulating financial institutions to ensure the safety of the US banking and financial system and to protect consumer credit rights. The next is the fostering payment and settlement system safety and efficiency through services to the banking industry and the US government that facilitate US dollar transaction and payment. And the last is promoting consumer protection and community development through consumer focus, supervision and examination, research and analysis of emerging consumer issues that trends, community economic development activities, and the administration of consumer laws and regulations. And this is a Fed open market operation. It's the main income of the Federal Reserve System by government securities that they have acquired through open market operation. Other sources of income include investment income from foreign currencies, interest from lending to depository institutions, and service fees, such as check clearing and money transfer fees provided to the institution. After covering their expense, the Fed transfer the remaining portion of their income to the U.S. Department to Treasury. Last is the Fed payment. The Fed use two payment system. The first is the Fed Now service. Is allow for instant payment, and FedWise is a payment service for financial institutions that hold an account with Fed. And finally, is a monetary policy tool. There is a 10 tool for Federal Reserve System. As we can see in the slide, there is a and the open market preparation is the main tool of the Federal Reserve System. That's it on the function on the main
Okay, I'll give you several more minutes, but you need to finish it quick, okay?
Okay. And now I will give you guys an overview about State Bank of Vietnam. Well, the first one is definition of Vietnam State Bank. Well, the State Bank of Vietnam, also known as the State Bank or Ngân hàng Nhà nước Việt Nam in Vietnamese, is the central bank and the highest monetary authority in Vietnam. It serves as the primary regulatory and supervisory authority for the country's banking and financial system. And I will move on to some functions of Vietnam State Bank. Well, as you can see here, they have function like acting as the central bank of the Socialist Republic of Vietnam, performs the state management function of the monetary, the banking, and the foreign exchange operation. They also performs the role of the central bank as the money issuer and also the provider of monetary services to the government, and performs the state management of the public services under the SBV jurisdiction. And the next part is some roles of Vietnam State Bank. As you can see here, they have 8 roles of Vietnam State Bank as promoting monetary stability and formulating monetary policy, promoting institution stability and supervising financial institutions, providing banking facilities and recommending economic policies to the government, and managing the country's international reserves. And printing and issuing banknotes, issuing government bonds, organize bond auction, supervising all commercial bank activities in Vietnam, lending the state money to commercial bank, being in charge of other roles in monetary management and foreign exchange rates. And this is some tasks and power of State Bank of Vietnam. As you can see here. Next slide, please. And now I will tell you about an example of State Bank of Vietnam. Well, in the generation from 2020 to 2021, the COVID-19 pandemic posed a major challenge to the Vietnamese economy. And the SBV responded to this challenge by implementing a number of measures, such as reducing interest rate to record lows, providing loans to banks and businesses at preferential interest rate, delaying debt repayment for businesses and households, providing direct cash transfers to vulnerable households. These measures help to mitigate the impact of the pandemic on the Vietnamese economy. Well, as you can see, Vietnamese GDP growth rate were 2.58% in 2020, which was one of the highest growth rates in the world during that year. In 2021, Vietnam's GDP growth rate were 2.59%, while the bank's quick and decisive action helped to prevent this recession in Vietnam and supported the recovery of the economy. The State Bank of Vietnam has played a key role in solving macro problems in Vietnam. The bank has been successful in bringing inflation down and supporting the economic growth. And now I will make a comparison between State Bank of Vietnam and Federal Reserve System in US.
I think you can stop here because we are going to compare among all the central banks in the world. Okay.
Okay.
Not only just Fed and SBV. So okay, I think you did a really good job presenting about 3 main central banks, in which we have like 2 big in the US and European, and also we have State Bank of Vietnam already. So the question I have for you is, what are the differences among central banks around the world? Tell me. Okay, compare between European Central Bank, Federal Reserve, and State Bank of Vietnam. What are the differences among them? I know that there are several functions that every central bank should have and similar, right? But what are the differences? Can you tell me? Anyone? You presented 2 biggest central banks already in the world already, but compared to Vietnam, compared to each other, what are the difference among them? I'll give you some minutes to think, but then I will call on somebody, okay? I just want to see if you have some critical thinking about the roles of the central banks and the functions of the central banks. And I saw one hand here. You can open your mic and tell me. I think I saw a hand.
In my opinion, the biggest difference between three central bank is the structure. When the Fed and ECB is independent, but the State Bank of Vietnam is state-owned.
State-owned. The other banks are government-owned too. They may have some partially owned by private sectors, but mainly they are still state-owned. That means they are monitored and they are belong to the government, right? So you think the other banks are not belong to the government? Okay, so let me ask you another question then. How many countries under European Central Bank, ECB? Do you know?
I think it's 27.
Is that right? Okay, so how about Federal Reserve? So the number of the country. Okay.
25.
No, Federal Reserve. Federal Reserve have manage only banking system in the US, right? And central bank is the central bank of the US. And State Bank of Vietnam manage only Vietnam too, right? So the difference between the European central bank and Federal Reserve and State Bank of Vietnam is that they manage different system, right? Because in the US, you can have 12 regional Federal Reserve, but all of them managing the US banking system. In European, you have one central bank and some other national central bank. So they would meet and they would discuss the policies, monetary policy for the whole system of the European countries, right? So that's a one different. What else? Anyone can tell me what is the other differences? From the presentation they show, I think somebody mentioned about the independence, Hong, right? What do you think about the independence? Which bank is more independent? Which central bank is more independent?
I think some central bank are fully state-owned, but there are some mixed ownership.
Yes, that's
they
right.
are privately owned.
Yeah, even the Federal Reserve. But they are still supervised by the government, right?
Yeah.
However, the independence level is different between central banks around the world. Okay, I think we don't have much time, so I think I will reserve time for the second group. Then we need to go to the lesson as well. I will tell more about the independence level of central banks later. But now let's get the second group started. I think it's group number 3, right? Group number 7, can you turn off the sharing? Okay, so group 3, are you ready to present?
Yes.
Okay, go ahead.
You see the screen?
Yeah, I can see it clearly, but it's not in the full screen mode. Okay, it's good now.
First, the money supply process is the mechanism by which the central bank and the banking system creates and control the amount of money in the economy. It is complex and dynamic process that involve various actors, instruments, and channels. The money supply is total amount of money available in a country, which includes cash, coins, bank deposits, and other liquid assets. The money supply is influenced by the action of central bank, the commercial banks, and the public. In this session, we will explain the money supply process using three main concepts: the central bank system, the central bank balance sheet, the culture of monetary base, and the simple model of multiple deposit creation. First, we will talk about three barriers in money supply process. First, the central bank means the government agency that oversees the banking system and is responsible for the conduct of monetary policy. In the United States, the Federal Reserve System, and in Vietnam, the State Bank System. Like to explain the financial intermediary that accept deposits from individuals and institutions and make run commercial banks, shipping and loan association, mutual shipping banks and credit union. And last is depositor, individual and institution that hold deposits in bank. Let's to central bank system balance sheet. The operation of the State Bank of Vietnam and its monetary policy involve action that affect its balance sheet, its holding of asset and liability. Here we discuss a symbolic balance sheet that includes the 4 items that are essential to our understanding of the money supply process. First, liability. The State Bank of Vietnam has two main liabilities on its balance sheet: currency in calculation and reserve currency in calculation. This is the total amount of Vietnamese love that is in the hand of public. It includes both physical cash and digital money held in bank account. Reserves, they are the assets that the State Bank Vietnam hold in foreign currency, bond, and other liquid assets. Reserves are used to support the VNG intervention in the foreign exchange market and meet Vietnam International Financial Operation. The left we will talk to asset. The two main assets on the balance sheet of State Bank of Vietnam are security and loan to financial institutions. Security are Vietnamese government bond and other financial assets that State Bank of Vietnam holds. The State Bank of Vietnam buy and sell security to implement monetary policy and to manage the government debt. Plus to financial institutions, they are run that State Bank Vietnam makes to commercial banks and other financial institutions. The State Bank of Vietnam provides loans to financial institutions to ensure that they have enough liquidity to open risk and support the economic growth. The State Bank of Vietnam needs to carefully manage its liability and assets to achieve its policy goals of price stability and economic growth. Now, I'd like to control of monetary base.
Now I will present about control of the monetary base. The first is the formula of monetary base. The monetary base, also called high power money, equals currency in the circulation C plus the total reserves in the banking system R. The State Bank of Vietnam exercise control over the monetary base through its purchase or sale of government securities in the open market, called open market operations, and through its extension of loans to banks. Example, so if there is $1 billion worth of currency in circulation and $2 billion in reserves, the monetary base is $3 billion. Open market operations are one of the main tools used by central banks to implement monetary policy. Through open market operations, central bank can buy and sell government securities to inject or withdraw liquidity from the financial system. However, central banks cannot determine the amount of borrowing by banks from the central bank, which is known as discount window. This because banks have the right to decide whether or not to borrow from the central bank, even if the discount rate is attractive. Therefore, the monetary base can be split into two components. One that central can control completely, and another is that less tightly controlled. The equation below clearly illustrates by this relationship. MBN equals to MB minus BR. And the next is a video about open market operations.
We cannot hear the sounds. Can you check?
What are open market? What are open market operations? Open market operations are one of the many tools the Federal Reserve Board has at its disposal to influence monetary policy. An open market operation is when the Fed buys and sells Treasury bills to change the amount of money in the economy. The Fed makes these trades with other banks and decides how much to trade by targeting a particular interest rate known as the federal funds rate, which theoretically affects other interest rates in the economy. So open market operations changes the money supply, which affects the supply of loans, and changes interest rates, which affects the quantity of loans demanded. There are two types of open market operations, expansionary and contractionary. An expansionary open market operation is when the Fed wants to increase the money supply and lower interest rates by purchasing Treasury bills from banks, thus increasing the supply of bank reserves. The new reserves would allow banks to make more loans, thus stimulating the economy, making it easier to start or expand new businesses or easier to get a mortgage. This increase in bank reserves would also lower the opportunity cost of banks loaning those reserves out to other banks, and that in turn would lower the federal funds interest rate. A contractionary open market operation is when the Fed wants to decrease the money supply and increase interest rates by selling Treasury bills to banks, thus decreasing the supply of bank reserves. You may be thinking, why would you ever want to slow down an economy? Well, contractionary policies are usually used to slow down inflation or correct for other distortions in the economy. Historically, open market operations were one of the most important tools the Fed had at its disposal to influence the economy. However, in more recent times, after the Great Recession, the Federal Reserve has relied more heavily on its other tools. To learn more about the other tools the Fed uses to influence the economy,
The next part is shifts from deposits into currency. Even if the State Bank of Vietnam does not conduct open market operations, including repurchase transactions, the shift from deposits to currency will affect the reserves in the banking system. However, such a shift will have no effect on the monetary base, another reason why the bank has more control over the monetary base than over reserves. Let's suppose that during the Valentine's Day, the public wants to hold more currency to buy gifts and so withdraws $100 million in cash. Let's look at the first table. Here's how the non-bank publics affect the T account. At first, the non-bank public's assets include $100 million in bank deposits. After the withdrawal, their assets are reduced by $100 million, reflecting the fact that they now have $100 million less in bank deposits. Their asset composition shifts as they now hold $100 million in physical currency instead, which means there are no direct change in liabilities of the non-bank public. On the second table, the bank system lost $100 million of deposits and hence $100 million of reserves. When customers withdraw cash, the reserves held by bank decreased by $100 million. The deposits in the banking system decreased by $100 million as the customer take money out of their accounts. This leads to a decrease in the liabilities of the banking system. The currency in circulation increased by $100 million. When customers withdraw cash, they take physical currency out of the bank, which becomes part of the money supply in circulation. For the State Bank of Vietnam, Jane Brown action means that there is $100 million of additional currency circulating in the hands of the public, while reserves in the banking system have fallen by $100 million. Let's look at the third table. Here's how the state bank system affects on the T account. The net effect on monetary liabilities of the State Bank of Vietnam is a wash. The monetary base is unaffected by the public wanting to hold more currency to buy gifts on Valentine's Day. But reserves are affected. Random fluctuations of reserves can occur as a result of random shift into currency and out of deposits, and vice versa. The same is not true for the monetary base, making it a more stable variable. Next, we will move to loans to financial institutions. We will give an example to describe it clearly. Suppose State Bank of Vietnam makes a $100 million loan to First National Bank. The effect of the State Bank system on T account on the asset side of SBBT account, there's an increase by $100 million because it now holds a $100 million loan from First Bank National. There's no immediate change in liabilities associated with this transaction, and the SBB's equity remains the same. As for First National Bank T account, its asset increased by $100 million as it received the loan from the State Bank. There's no immediate change in liabilities associated with this transaction, and the equities remain the same. So the effect of both State Bank to First National Bank is an increase in assets for both banks without an immediate impact on their liabilities or equity. This represents a typical loan transaction in the banking system when a financial institution provides a loan to another financial institution. It records the transaction in its T account or balance sheet. The impact of this loan transaction on the T account lending institution T account, it decreased in loans receivable on its asset side and no immediate impact on liabilities. As for borrowing institution, it increased in cash or deposits on asset side and increased in loans payable on liability side. The next part is other factors that affect the monetary base. There are float treasury deposit at the State Bank Reserve and intervention in the foreign exchange market. As for float, this refers to the net amount of checks in the process of collection. It can temporarily increase the monetary base until the checks are cleared. As for treasury deposits at the State Bank Reserve, when the government deposits its revenue at the central bank, it reduces the monetary base because these funds are no longer parts of the circulating currency. And as for intervention in the foreign exchange market, when a central bank buys or sells foreign currency in exchange for domestic currency, it can affect the monetary base. For example, if the central bank buys foreign currency, it is in domestic currency, and this reduces the monetary base.
Next, we'll move to the multiple deposit creation, a simple mode. The first is the single bank. Now that we've seen how the State Bank of Vietnam can supply additional reserves to the bank system, let's go on to consider what happened at the specific bank as they received those additional reserves. Suppose that the Flat Bank had just sold $100 in treasury bills to State Bank of Vietnam. You can see on the screen is the T account of the Flat Bank, and since the Flat Bank now increase its checkable deposits, its required reserve had not changed. Hence, the $100 in the new reserve are assessed reserve. Assume that the flat never wants to hold the assessed reserve. It may decide to make a new 100 loan. And when the flat makes that loan, it credits the borrower checking account with an additional 100. You can see the second table is the new T account of the Flat Bank. But the story can't end here since the presumably flat borrower asked for $100 loan because he or she wants to make some sort of purchase. So suppose that the borrower runs a small business and uses the $100 loans to purchase the material from the supplier to purchase the material. The flat bank borrower write a check to the supplier. Assume that the supplier never wants to hold the currencies. He or she will deposit the check in his or her account as a new bank is a Citibank instead of simply cashing the check. Citibank then deposits the check in its account as the State Bank of Vietnam, and the State Bank of Vietnam transfer $100 out of flat account into Citibank account. You can see that on the screen is the comparison between the T account of Flat Bank and Citibank. After the State Bank of Vietnam transfer 100 out of Flat account into Citibank account. But once again, the story can't end here because we need to ask about what Citibank will do with the new reserve. Then next to the second part, the banking system. And by law, the Citibank must hold $100 multiple 10% or $10 as a required reserve. So Citibank now has $90 in asset reserve. Assume that the Citibank never wants to hold asset reserve. It may decide to make a new $90 loan. When the Citibank makes this loan, it credits the borrower checking account with an additional $90. But once again, the Citibank's borrower presumably asked for the $90 loans because he or she wants to make some sort of purchase. So suppose that the Citibank borrower write a $90 check to buy material from a supplier. Assume that the supplier never wants to hold currency again. He or she will then deposit the check in his or her account as the new bank is Bank of Hanoi instead of simply cash the check. The Bank of Hanoi then deposits the check in its account as the State Bank of Vietnam, and again the State Bank of Vietnam transfer $90 out of Citibank's account into the Bank of Hanoi account. You can see on screen is the comparison between the T account of Citibank and Bank of Hanoi. And by law, Bank of Hanoi must hold $9 as required reserve. So the Bank of Hanoi now has $81 in excess reserve. Assume that the Bank of Hanoi make a new $91 loan, and so the process continues. But now the supplier deposits the check in his account as the new bank is Viet Capital Bank, and more process. And you can see the final result as illustrated in this table. To conclusion, the $100 increase in this reserve lead to a $1,000 increase in deposits. So how to calculate the increase in deposits? Next to the simple deposit multiplier.
The simple deposit multiplier is a ratio between bank's reserve and bank's deposits. It's important for maintaining the money supply of the economy and the banking system. The deposit multiplier is the maximum amount of money banks can create based on the reserve units. It's the multiple that banks use to know how much they can lend out, and the money is kept on hand according to the existing reserve requirement. The deposit multiplier is typically a percentage of the amount deposited at a bank. Here on the slide, you can see that this is the formula of the simple deposit multiplier. Delta D is equal to 1 I'm so sorry for this. Delta D is equal to 1 out of RR and multiply with delta R, where delta D is change into total checkable deposits in the banking system. RR is equal to required reserve ratio, and delta R is the change in the reserve for the banking system. The simple model of multiple deposits creations provide a basic framework for understanding how bank can expand the money supply through lending. However, it is an oversimplification and does not capture the complexities of the real-world banking system. Here are some of the critiques of the simple model. First of all, the process of multiplier deposit creations will be interrupted if the depositor decide to hold cash. Secondly, banks may not use all of the excess reserve to buy securities and make loans. And thirdly, the money supply is not only determined by central banks and the reserve ratio, but also by the decisions of depositor and banks. Next up, to understand more about the critique of this simple model, we have a case study of the Great Recessions. During the Great Recessions, which began in 2007, the US economy experienced a severe decline in economic activity. One of the contributing factors to the recessions was the freezing up of the interbank lending market. This meant that banks were reluctant to lend to each other, which in turn reduced the ability to lend to customer. As a result, the simple model of multiple deposit creations did not accurately reflect the actual behavior of the banking system during the Great Recessions. Banks were not lending out all of their excess reserve, and depositors were holding more of the money in currency. This reduced the amount of money that was available in the economy and exacerbated the recessionary conditions. The Great Recession is a clear example of how a simple model of multiple deposit creations can be inaccurate in realistic setting. These factors mentioned in the critique, such as bank holding excess reserve and depositor holding currency, can significantly limit the extent of multiple deposit creations. That's the end of our presentation. Thank you so much for the attention, and we are very thankful to receive the comments and the questions if you guys have. Thank you so much.
Anyone have any questions for them? I have a question then. If no one have question, can you go back to the slide? I think talking about the policies. You mentioned about the open market operations. How about the two other tools? No, not this one. Okay. Oh, okay. Can you go to the very beginning slides? Okay. Stay here. Component center and less time control. Okay, can you explain more about, I think because you put currency in circulation and the total reserve in the T account. So can you explain more clearly about what is currency in circulation for the class to understand, and also explain about the reserve. What is the reserve?
Yes.
Can
Because we also prepare a game for you guys to play. So maybe when we are preparing the answer, we will play the game. Is this okay?
Okay. Yeah, that's
thank
fine.
you so much.
And class, please pay attention to their presentations and the game. I'm going to record all the people who are participating in the participating in the discussion, and then I will tell cô Hương and Thầy Thái to have bonus points for those. Okay. I record whom have some bonus point today.
You can scan the QR on the screen.
Mm-hmm.
And the ID on the screen too. If you can't scan the QR code. We will wait to 20 participants to start the game. Okay, let's start the game. Oh, we just have about 45 seconds. Oh wow, the two now double his coin. Congratulations
Is there
to Chung.
is there any reward for top 3?
Maybe một tràng pháo tay ạ.
Okay.
Yes.
Okay. So
Yeah.
now you can answer my questions, right?
So since the game is ended, here is our answer to the questions to explain more about these currency in circulations and the Ttnh reserve in banking system. The currency in circulations refers to the physical cash held by the public, businesses, and banks. It encompasses all the banknotes and coins in use within an economy. Currency in circulations is considered a highly liquid asset as it can be readily exchanged for goods and services. It plays a significant role in everyday transactions, facilitating commerce and enabling individuals to make purchase. And Ttnh reserve in the banking system represent the deposit that banks maintain with the central banks. The reserve serves as a safety net for banks, ensuring that they have sufficient funds to meet their obligations to depositor and fulfill the liquidity requirements. The central bank regulates the amount of reserve banks may hold, influencing the money supply and overall economic stability. And maybe to a question that why we have the formula that MBN is equal to MB minus BR. In the we have a form that Miss Hung sent us, and in the form of our presentations, she required that we need to have the open market operations in that. And when we are searching for the information in this part, it also I'm so sorry. It also shows a result of this formula. So we think that we need to add this in to help our presentations more fulfilled. Yes, that's our answer. Yeah, thank you so much.
That's good. Yeah, that's good. Just remember, even the reserve is count not only the money that commercial banks have to put in the central banks, but also count the money, the cash involved in their banks. Okay, so the reserve might be money at the central banks and also money at the vault cash. That's the requirement for holding a certain amount of money to meet the requirement. Some commercial banks, they may even have excess reserve, and they may have some interest on that excess reserve.
Yeah, thank you so much for the information. We will add this in our...
Okay, so I think we may need to have some time to have a break, okay? And I don't know, normally how much time do you have for the break? Maybe you should have 10 minutes. Is that okay?
Yeah, it's okay.
Okay, so we are going to have 10 minutes break and then we will be back. I think because I don't know that your presentations, most information I need to tell you, you already presented. So I think I'm going to show several points that I just want you to really understand, not only from the presentation, but you need to understand it. And if you have any other questions about any point along with the point that two groups already presented, then you may ask me, okay? And then after that, I think we can discuss a case study because we have a lot of the real case and we can discuss about how central banks around the world can manage the banking system in their country. And I actually put the two cases into the chat. So after the break, we can discuss about the first case, okay? We will save the second case for next meeting then. Okay, so I will be back here at 11:45. We can have a break now. Okay. Can you see my screen? Sorry, I did not put on my microphone. Okay. Can you see my screen now? Hello?
Yes, just we can see.
Okay. Thank you. Okay. So I'm going to what should I say? I'm going to stress several points that I think you need to understand about the central banks and also about the um, supply of money. Okay, so in this chapter, actually, we are going to learn about the central banking systems and also the conduct of monetary policies. And I think most of the presentation already presented the main learning objectives, but I just want to remind you several points. And if you have any question along the way, just let me know, okay? Okay, that's easy. Okay, so remember the main function of a central bank is conducting the monetary policy, and also they are in charge of the banking and foreign exchange operations. They also perform the function of a central bank in issuing money. Also, banks of banks and banks of government. You all mentioned about that, so remember that. So there are two main types of central banks in terms of independence. The case for independence, for example, Federal Reserve, European Central Bank, or Bank of Japan, they have a higher level, higher degree of independence. And for these central banks, there is some arguments why they shouldn't or why they should have a high level of independence. Most of the opponents for independence, high level of independence, central bank say that because the central banks are normally in any country, they would have the election periods. When in election periods, most of the politicians, they are trying to impress the voters. So that's why they try to have a very short-term policies to boost the economies. And normally it would have like the inflations at that time. So that's why they argue that we need to have a very independent central bank. So it do not be affected by the governments and by the politicians for their election cycle. For the case against independence, for example, State Bank of Vietnam is centralized and also managed by the government. Then they argue that the government and the central banks need to work together. The fiscal policies and the monetary policy need to be aligned with each other. And also, government is in charge of the whole system. Why they cannot, monitor and why they cannot interfere with the monetary policies. So that's why they want a centralized, more centralized and more dependent central banks. So the difference among central banks around the world is about the independence level. Some governments, they have a very high level of independence, but some governments, they don't want to have a high level of independence, central banks. And the second thing I want to mention to you is that the difference among central banks around the world is about their mandate. several banks, most of the banks have two main goals. The first goal is to stabilize the price in the market for the countries, right? And the second goal is the reduce the unemployment rate. So they have to balance between two goals. There's some central bank, they want to have balance between, for example, a Federal Reserve, because they are one country. They want to have their price stabilized. At the same time, they want to have the low unemployment rate. So sometimes there's some goals that are conflicted to each other. But some other central banks, such as European central banks, because they are not in charge of the members. They have 90 members, right? They are not in charge of the members' unemployment rates. So their goal is more toward to the goal of price stabilizations, okay? And also for the structure, you can see that from the presentations, some Federal Reserve have different structure from central bank, European Central Bank, and different structure from State Bank of Vietnam, of course. And also the policy tools that they are using are different too. There are several tools that some central banks may prefer to use. For example, reserve requirement or open market operations. And there are some direct and indirect tools that Vietnamese government want to do. For example, the direct interventions such as raising or lowering the credit limitations for commercial banks. So those are the different tools that different central banks they may utilize to reach the goals. Okay. Here is some reason for the case for independence and the case for against dependence. Here are some conventional monetary policy tools and non-conventional monetary tools. In fact, we can call it indirect policy tools or direct policy tools. For example, open market operations is indirect tools because the central banks will buy or sell securities in order to pull our money into the money supply, into the markets, or withdraw money from the market to their banks, the central banks, to control the interest rate. The discount lending is another tool, but it's also indirect tools because the central banks will lend out to commercial banks with the different interest rate, right? So it will pull out money into the market, or it won't pull in money back to the central banks. And other tool is reserve requirements. It depends on the type of central banks. They may have different type of reserve requirements. Federal Reserve may require banks to have a certain amount of reserve based on the deposits that they have at the bank. But State Bank of Vietnam, for example, they may require reserve requirements based on type of credits, type of the banks. For example, for agriculture banks, the reserve requirement is very low, maybe 1%. But for rural or for urban commercial bank or joint stock banks, it might be higher, like 2 or 3%. So it depends not only the type of deposits, but it also depends on the type of the banks that have to apply the policies. Interest on reserve, normally if they have excess reserve, they may have some interest. Commercial bank may have some interest from central bank, and dependent, of course, it depends on type the banks, right? Non-conventional monetary policy tools, for example, liquidity provisions or large-scale assets purchase. It depends on the banks and the policies and the periods that they apply those direct tools here. Liquidity position, for example, in some periods in Vietnam, some banks may have a certain requirement for liquidity. For example, they can use a certain short-term deposit to lend out for long-term loans, right? So that's can match between the duration of their assets and duration of their liabilities. Similar large-scale assets purchase, they may require bank to have a certain limitation on the large-scale assets purchase. Okay, so this is, I think we are detailed. Okay, and remember there are three main players in the money supply process: central bank, banks, and depositors. Depositors mean individuals and institutional depositors, such as businesses. Okay, I'm not going to repeat this one. This one is already, you already have. So I think in here you need to remember there are several factors that can determine the money supplies. The first one is the Federal Reserve System. There are several variables. For example, non-borrow monetary base, change in the variable. If non-borrow monetary base increase, the response of money supply response is increased. So the more money base for deposit creation, then the money supply would increase. Also, the required reserve ratio, RR, if it's increased, that means banks have to put more money in reserve. They cannot have a lot of left money to borrow, to lend out. So that's why the money supply will decrease. Okay, for banks, if the borrowers' reserve increase, then they have more money in their banks in order to lend out. So that's why the money supply increase. And if they have more excess reserve, or they have increased exit reserve, that means they are not lending out. They just keep money in their vault or at the central bank account. Then the money supply in the market will decrease. And also the depositors, if they hold a lot of cash, so currency holding increase, then the money supply in the market will decrease. Okay, so this is the table that I want you to understand and remember. That's it. Okay. So those are some points that I want to explain it to you. And do you have any questions? Any questions about what we have learned today? Okay, if you don't have any questions, we are going to the discussion part about the case study we have today. So I'm going to open the case study and we can Can you download the case study already? Let me see. And you have to open it in a PDF, okay? Okay. The first case study is the effectiveness of negative interest rates policy, a case study on Japan. So I will give you about, let me give you 5 minutes to read, and then another 5 minutes to discuss within your group. And then after that, I would like each group will type into the form that I will give you a link. Okay. So just read the case study and then we can discuss about that. Are we all clear about that?
Yes.
Okay. Just let me know if you don't understand any part in the case study, okay? Let me have the form so you can fill in that form. Let me see if I have a Google Doc here. Can you click to the seat if you can see the questions and the blank columns that I created for each group? Going to share that to you.
Cô chưa mở quyền truy cập ạ.
Cô mở quyền truy cập đấy ạ.
Okay, how can I do that?
Có một cái phần share bên góc phải màn hình trên cùng ạ.
Okay, wait for me, sorry. Oh, I have to click share, right? Okay. Work. Okay. Search. And okay. Sorry, I cannot do this. Restricted. Okay. Anyone can do this, the form, the Google Sheet for me. I cannot share with you because it's restricted to my computer. Anyone can do this for me? Like create the form like this for me.
Cô ơi, cô vào lại cái phần share ạ?
Because my account cannot share. I'm sorry, because it's the education account. So I cannot do that. It's not our university account. I use another account. So I cannot share.
Cô ấn lại vào cái ạ. Đấy ạ. Cô ấn vào cái phần restrict ạ. Cô chuyển thành
It's not working for my account, so I think you may have to create for me. Oh, it's okay. You can put it in the chat box.
Ôi,
okay.
Vâng, em vừa tạo một cái sheet mới ạ.
Okay. If you can share that
Em
to
có gửi vào chat box rồi.
the group. Okay. Thank you. Okay, can you share that? Can you share that sheet for everyone? The Google sheet. So everyone can type on there.
Em có mở quyền truy cập cho mọi người rồi ạ.
Okay. Thank you. Okay, so we would have like 3 rows to answer for 3 questions. And also each group will have 8 rows respectively, okay? And then you can answer the question based on your opinions. Then we can discuss from there. Anyone want to read briefly the article or share the article? Or let me share the article first. Let me see. Where is the article? Okay, so we have the first case study. And in this case study, we have 3 questions. The first one is, What is the negative interest rates policy, NIRP? And why Bank of Japan decided to implement the negative interest rate policy? And the last one is using the supply and demand curve of Japanese government bonds to explain the relationship between the price of bonds and the interest rate. So those are the questions that you need to answer and put in the Excel sheet. Thank you, Har. Let me see. I'm going to share the screen so you can see what you are doing here. Okay, I think most of you understand what is a negative interest rate policy of the government. That's very strange policy, right? Okay, negative interest rate is an anomaly in the financial world. Central bank said its target nominal interest rate is less than 0%. Strong encourage borrowing, spending, and investment rather than holding cash. We lose value to the negative deposit rate. Okay. Less than 0%. Okay. What group is this? Group 9. Let's make some more. Okay, let's see. Group 1 and group 2. Wow. Demand of bonds. As the interest rate decrease due to the implementation of the demand for bond increase. Investors are more inclined to purchase bonds when the yield are relatively higher compared to negative rate on other assets. Supply of bonds inversely related. Excellent. Yield curve effect. I think I may have to give it to cô Hương and Ttnh because you can answer this very okay. Okay, who can tell me what is negative interest rate policy? I saw a lot of good answers here, but I just want somebody to tell me, and then we can finalize the case study here. Who want to tell us, our class, about negative interest rates policy? Anyone? You just need to open the mic. Who is that?
Okay. I'm Hoàng Hà.
Okay, Hoàng Hà. Tell me what is that?
I read the paper and I see that a negative interest rate policy is an anomaly in the financial world, and it is like it happened in many countries, and it starting in Denmark in 2012, and it occurs when the central bank sets its target nominal interest rate at less than 0%.
Why do they have to do that?
I think they do that in some cases to prevent the economy from falling into deflation by granting loans at almost no cost, like Japan. Japan implemented negative interest rate in 2016 in an attempt to spur economic growth, and super low interest rates would also help Japan afford the payments on its massive amount of debt.
Okay, so the central banks may set even the negative interest rate, right? Because they can encourage people to invest and to spend instead of holding cash, because cash is not going to give you any interest, right? Even they even, for example, the central bank, they even charge the commercial banks if they have excess reserve in the bank, in the central bank. Okay, so that means they encourage not only people in the countries, industries, and also the commercial banks to lend out, not holding cash at all. And then they can boost the interest rate and avoid deflation, and also avoid the very low interest rate in the market later on. Okay, so that's the first question. The second question is, why Bank of Japan decided to implement the negative interest rate policy? Why did they do that? Based on the case study, who can tell me? Basically, the first question have some information already, but I just want to make sure that you understand that. So why did they do that? And what is the in this case study that we know that why Bank of Japan decided to implement that policy? Anyone can tell me? Okay, you can see that in this case here. They actually do that for a short term to impact their long-term interest rate, right? And like I mentioned before, and some of you mentioned it in here, they wanted to combat the deflations, and also they want to stimulate the economic development. Because if people are spending, then the companies can sell their products, and they can expand their production and also their operations, right? And also, if banks holding a lot of cash, they may have to pay for central banks, and that make them, I mean, have to find ways to lend out money that they are holding right now. So that's why Bank of Japan have to do that. Anyone have any other ideas about why Bank of Japan have to do that? Okay, how about the last question? Let's see the bond, the price of bonds and the interest rate. What happened to that? If you look at the figure 1, Japanese government bond yield curve, you will see how it goes from June of 2015 to June of 2016. You can see the graph here that the interest rate is increase, right? The bond yield curve increase. Why is that? Let me see your answer then to see if you. Okay, some of you have a very long answer. Okay, the bond supplied. Did you learn about the interest rate several weeks ago, right? So the interest rate and the price of bond are going into same direction or opposite direction. Do you still remember? They have to go to the opposite direction, right? They have negative association. If the interest rate increase, then the bond price would decrease, right? So when in Japan have negative interest rate from the central bank, it encourage people to not holding cash. They have to find a way to invest their money. And bonds might be one of the channels that they want to put their money in. So that's why so many people want to buy bonds at that time. And according to the supply and the demand curve, the supply curve would go upward, right? And the demand would go downwards. So when the demand for bonds increase, the price for bond increase or decrease? At that time, anyone can tell me? If the demand for bonds increase, then what happened after that? Then the supplies still remain constant and the price, of course, increase, right? The price increase, then the price and the interest rate of bonds are negatively related to each other. So if the price of bonds go up, the interest rate goes down. And in converse, if the price of bond go down, then the interest rate go up, right? So as you can see here, when the price of bond go down, the interest rate of the bond or the bond yield curve increase. So that's how they can increase the interest rate and encourage the economy to invest more, spending more, and then the economy can go back to normal and better than deflation, right? Okay, I think that might be for today. What time is? I think we are run out of time, right? Okay. So I think for today, that's enough for today. But for the next time, I need you to read the case study in advance, and then we can discuss more about the second case study. Okay, and I hope that you are engaged more in the lesson. And let me ask you a question. How many presentations do you have per lessons? Do you have any presentation next time? I mean, next meeting?
Usually we have one presentation each lesson. So yeah, next time maybe we still have one more group presenting.
Oh, okay. So what is the presentation topic for next week that you have? What group is going to present next week? Or that assigned by the teachers, or you just register for that?
Next week we will have a group board presenting, and the topic is on Padlet already.
Oh, what is the topic of group 4?
It's also about the money supply process. It's the next part after us. We are group 3.
Okay.
Yeah, the final one.
Okay.
Yeah.
All right. So, okay, I'll see you next week then. You can leave today, and hopefully next time we will have more discussion instead of presentation. And group 4, please have like 25 minutes, okay? Today we ran out of time for both groups and the whole lesson. Sorry that I have like some extra time for you this time. Okay, so see you next week and have a good day, okay?
Em chào cô ạ.
Cảm ơn các em nhé. Cô xin lỗi là cô cũng không để ý giờ, đâm ra là hơi bị quá giờ một chút ngày hôm nay. Thế nhưng mà lần sau cả các nhóm nhớ trình bày ngắn ngắn thôi nhá. Trình bày dài quá làm cô thấy mất cũng khá nhiều thời gian của lớp mình á. Ok, chào các em nhé.
Em chào cô ạ.
Em chào cô.